Our second learning module will be how to do a bank reconciliation and understand the components of a bank rec. So first of all, internal control over cash is probably one of the hardest ones to do and is probably the most important one. Since cash is a highly desired asset and easily concealed, taken and converted into other assets with only a small chance of detection, there are two key cash controls that we include in bank reconciliations and petty cash. Petty cash you will be getting in module number 3. This one will be only dealing with the bank reconciliation. So let's go ahead and take a look at what a bank reconciliation is. It is prepared as follows. What we're going to do is we're going to take the bank balance to the actual to the actual cash balance in our books. In other words, it's going to be our job to make them equal. You will see when we start out, they are not equal, but when we are finished, we have reconciled them to one another. The second one is reconcile the company's book balance to the actual cash balance. Then adjust the company's book balance to the actual cash balance. So what we'll do here is we'll need to prepare some journal entries of all the activities we found that will need to be added to our actual cash balance in the books. So first of all, we have to talk about some terms that are associated with bank reconciliations. So the first term that we have is a credit memorandum. It's in addition to the cash balance on the bank statement for items such as the collection of interest. So what will happen is that the bank will receive this and we will have to make an adjustment to our cash balance on our book. And I'll show you how to do that here in a minute. A debit memorandum is a subtraction from the cash balance on the bank statement, for items such as service charges. So the bank will charge us for doing our banking for us. And typically it is on the bank statement, but not on the book balance. And so we're going to need to make an adjustment for that. Third, we have something we call deposits in transit, a deposit that has been made by the company but does not appear on the bank statement. We abbreviate that as DIT, deposit in transit. Last, we have something we call an outstanding check, a check that has not been distributed by the company, has been distributed by the company, but does not appear on the bank statement because it hasn't cleared the bank yet. We call that O/S for outstanding checks. So a deposit in transit, if we go back to that a minute, is a deposit that you have put in your company's checking account, but when you took it to the bank was closed and they don't have it in their bank statement balance. So therefore, we need to pretend when we look at the bank statement, we need to pretend what if they had all the deposits, as well as what happens if all the checks that are outstanding, because we all know we get checks, we write checks to our bills, or grandma writes us a check and we lose it, and she keeps asking us, Johnny, when are you going to go ahead and cash that birthday check? And you don't have the heart to tell her that you lost it, but that's an outstanding check that she has taken out of her bank balance. And so that also happens to a company, that a company takes it out of their balance, but the bank doesn't know it exists yet because the bank hasn't seen it clear the bank. So our job is going to be to reconcile the two. So what you're going to slide here is an example of a bank reconciliation. What you have on the top is the bank part. What you have on the bottom is the book. Now, when I'm going to do this, I am going to do them side by side. I like to see them side by side. You can do them whichever fits. You know, obviously, Cengage is probably going to present it this way, but I like to do them side by side. So our job is going to take this balance per the bank statement, which you see here, and you see here is the company book one, and what you notice is they do not equal. So it's your and my job to make them equal by seeing who has what and what needs to be adjusted to each. You can see here after we're done, they do in fact equal, and we have a successful bank reconciliation. And we're going to walk through that step here in a second. So obviously, if you see things down here on the books, we started with this, but now it's this, which means we have to add these entries into this balance through a journal entry. And the next slide is going to show you examples of that journal entry. So you can see here they collected receivables for us. We had an error, monthly service charge, and an NSF check, which stands for non-sufficient funds. And what that is a customer of yours gave you a check to pay off their account, and then it was presented to their bank for payment by our bank, and they had no money. So the bank's saying, whoa, you got to take that out because it's not really a deposit. So therefore you have to add it back to the accounts receivable because now they owe you that money again. And we're going to walk through a couple of examples. Before we go through a real life bank reconciliation, I want to talk about some of the things you might see in a bank reconciliation. So I'm on page 124 once again, and I'm looking at exercise number 4. Exercise number 4 has 5 items, and what we're going to determine is what would the treatment be on our particular bank reconciliation. And so it says, number 1, the company recorded a deposit as $540, but it correctly cleared the bank as $450. So what we know here is we have an error. The error is actually with me, the company. I recorded it wrong. But when the bank cleared it, they did it right. So the bank did it right. So the amount that's in the bank is good. What I have in mine isn't and needs to be adjusted. What the adjustment is what I have, which is the $540, minus what was the real amount, which is $450, which gives us a $90 difference. This difference needs to be subtracted from needs to be, so that $90 difference, which I put too much, needs to be added back to the bank. Added back to the book. So added back to mine, because I have $90 too much out. So that would be number 1. Number 2 says, a check recorded for $1,000 is shown on the bank statement as $1,000. So number 2 isn't relevant. It's perfectly an okay transaction. Number 3 says, the bank statement shows a $25 monthly service fee. So that service fee is showing being reduced from the bank, but I, the company, haven't, so I would need to subtract that from the book balance. Number 4 is a $32.50 deposit made by the company is not reflected in the bank statement. So I'm showing it, but the bank is not. So the bank doesn't have enough money in, so that would be called a deposit in transit and would be added to the bank. Number 5 says payment received from a customer is reflected on the bank statement, but not on the company's book. So the bank is showing it, but the book isn't, so I would need to add that to the book. So all this exercise of a bank reconciliation is trying to get the numbers to equal, to include those things that the bank might be showing on the books or that on the books which the bank doesn't have. That's what our exercise is. This next exercise we're going to go ahead and take a look at is on page 126, and it's number 15. And we are actually going to prepare a bank reconciliation. What I like to do is I like to do bank on this side. You can see in our example before, they did it side on top of one another, and book on that side. Here is going to be the ending statement balance. I like to set this up. Ending book balance. Okay? And then we know we're going to have some adds and we're going to have some subtracts. We're going to have some adds and we're going to have some subtracts. Okay? And then our job is to come up with the same ending bank balance. Okay? Have the same ending balance. So let's go ahead and work through the problem. It says McKnight Company's June 30th bank statement shows a balance of $14,750. So this is the bank statement, $14,750. Then it says McKnight's books, which is on to the right here, shows a balance of $13,600. So right here you see that they do not balance, and our job is to make them equal one another. And so what we're going to do is that's what we're going to do. And we're going to take each of these transactions. So number one says deposits in transit as of June 30th are for $1,000. That $1,000 is already included here, but it's not included here because it tells you that it's deposit in transit, which means it has not reached the bank yet. So we're going to pretend as if it did, and we're going to add that deposit in transit for $1,000. Deposits in transit only go on the bank side. You will never see it on the book side. Number two, outstanding checks as of June 30th are $2,500. So again, the outstanding checks are in this balance, but they're not in here. So we need to do that. So we're going to subtract outstanding checks. Outstanding checks will only be subtracted from the bank side, never from the book side, because they've already been reflected in that particular balance. So we've taken care of 1 and 2. Let's go ahead and take a look at number 3. $100 service charge reported on the bank statement. So the bank took $100 out here. I didn't know they did, so now I need to do that. So I'm just going to put bank charge as a minus of $100. An NSF check returned with the bank statement for $1,500. So the bank said, hey, this bozo didn't have any money. You need to take it out because I wasn't able to put it in my bank account. So with that, all NSF checks are always a subtraction on the book side only. So this would be a subtraction of $1,500. Then interest on the note receivable collected by the bank of $1,250. So the bank on our behalf collected $1,250 for us. We're going to need to go ahead and put notes receivable and add that of $1,250 on the book side. Well, we've taken care of all of the possibilities here. So now let's go ahead and do the math. So on the bank, I have $14,750 plus $1,000 plus minus $2,500, and I end up with $13,250. On the book side, I have $13,600 plus $1,250 minus $100 minus $1,500, and lo and behold, I have $13,250. We balance. If you do this exercise and they don't balance, then you have either an addition or subtraction that has been done incorrectly, or you might have it on the wrong side of the bank reconciliation. Your objective is to take those items and put them where they should be, as if everybody had zero timing issues. This is all having to do with timing. Now what we have to do is we have to take those items that are here and we have to do a journal entry for them. And that journal entry would look like this. I'm going to have a debit and a credit. So I do the adds first because that's easy. I'm going to go to cash for $12.50, and then my credit in this particular case, they said it was for interest. So it would be interest revenue or interest income for $12.50. It could be notes receivable, it could be accounts receivable, depending on the details that they give you. In this case, I am then going to debit bank charge expense or bank service charge for $100. I'm also going to add to accounts receivable the NSF check because they owe us that money, and I'm going to credit cash for $1,100. Those would be our journal entries. So the things to review before going forward and doing your particular problems is that deposits in transit and outstanding checks only on the bank side. When the bank collects for us, it will always be added to the bank and either could be interest or a minus to notes receivable or accounts receivable. The subtractions, if it's an NSF check, would go to an accounts receivable as your particular adjustment. The best way for you to go forward is to do a couple of examples, and the more you do, the easier it becomes to understand what goes where. Now, in this particular problem, before I leave you, depending on what errors can be added or errors can be subtracted. You just have to decide what that is. In my example a couple slides ago, that error would have been added back to the book side. So have fun with this. Look forward to any questions that you might have, but please give it your best shot.